Guys, welcome back to the channel. Today the portfolio is sitting about $1.15 million. I don't think we have moved a lot, so I think my portfolio is in a bit of a consolidation phase where it's not really moving anywhere, and it's you can see up and down, and stuff like that. But it's fine. I know. Congratulations to everyone who's in the markets these past weeks or so, because everything seems to be an all-time high. So if you've just bought the index, for example, you probably have done pretty well. Okay, so you're probably up about 12%. If you did buy the big tech cap names, for example, so for example, if your entire portfolio was, for example, 100% Google, right, you would be up about, I think, 26%, if I'm not wrong. Yeah, let me just check for you guys. Yeah, so like if you buy into strength, right, if you buy into like very, very strong companies, you should not worry too much because, yeah, in over the long run, these companies are extremely strong. So you don't really have to worry about that. Yeah. Um, yeah, so I mean, Google all-time high right now. If you were just seated in Google, did nothing at all, like you would have been up about 26% or so. Yeah. All right. So in this video today, I want to talk to you guys about why I don't really buy companies like Nike, Lululemon, stuff like that. So I just give you a bit of context so you understand. Okay. So I come from like the e-commerce space where I do like advertising and stuff like that for these brands. So like physical product brands who are, for example, they are reliant on China or Vietnam supply chain, for example. So they're making the stuff in Vietnam, China, Southeast Asia, and then they're exporting it to the Americas, to Europe, etc., etc. So these are types of companies, for example, they are in the consumer cyclical niche, for example, you can see over here. So number one, you're in consumer where there is not much recurring revenue, right? So let me just explain. So a very, very strong business is basically, imagine if I acquire a customer the first time here, right? And then in the future, for example, month two, month three, month four, they continuously pay me, right? So an example of this would be, for example, your Amazon Prime, right? Every single year they charge you about $99, for example, and then every single year you just renew the membership one time, one time, one time. And so, for example, the value of that company or the value of that customer it goes from $900 to over a 4 year period, it goes to $400, right? So it's a $400 increase. Okay, this is very, very consistent because every single year you're expected to renew your membership if it's good enough, right? If you think about Netflix, for example, I don't know how much Netflix is for you, but imagine they're charged like $15 a month, right? So by month number four, this customer will be worth about $60. So this is something called LTV, by the way, if you are not aware. This is a marketing term, customer acquisition term, but basically LTV stands for lifetime value, and lifetime value will basically tell you how much a company can extract from a customer over the lifespan of it being a customer. So this is extremely important because this is how you grow the revenue and how you grow it consistently. Okay, so this type of model is like recurring revenue. That's why that's like the MRR model. If you see anyone in SaaS, for example, all the software companies, for example, the reason why they are valued so highly is because their revenue is very, very predictable. Over every single month, you know exactly how much the customer will pay you. All right. However, these consumer companies, for example, a Nike, a Lululemon, for example, right? If I buy an Air Force One, okay, so let me just draw Air Force One over here for you. Okay, so this is one shoe, right? The shoe could cost you $150. Okay, and for example, there's like maybe 30% profit on that. So maybe Nike makes like $20 or $30 off this shoe, for example. Okay, just example. Okay, we do not know when the customer will come back a second time. Okay, they may come back a year from now. They may come back 2 years from now. We have no idea what's gonna happen, right? So maybe they come back like 8 months from now, right? Or Christmas time, right? They come out four months from now, right? And then they pay you $100, $100. You can see, right? The revenue is very it's like choppy. It's like there's no predictable revenue, and that's why if you see the revenues and the profits of a Nike business or a Lululemon business, they are very cyclical. They're very up and down, up and down. All right, I can basically show you exactly what. Okay, I think it's in the legacy view. Let me see. Yeah, so if we go into the last 5 years, right, you can see Nike, like it doesn't really move. You can see like it's up, it's up, it's up, down. Okay, it's like Christmas period, right? I think if I'm not wrong, Q4 is the Christmas period. Um, or maybe Q1 is a Christmas period. I'm not too sure, but you can clearly see like the revenue is not really moving, right? Okay, you might say, for example, like Nike is a very, very big company. So if you're already a very big company, it's very difficult for you to continuously grow, right? If you compare that to Lululemon, Lululemon is not a very big company. It may appear very big, but in the revenue segment, they're actually not very big, right? So now they are a $18 billion company, and then I think the stock crash basically really, yeah. So you can see, right, their revenue is spikes in Q4. You can see it is spiking. This is the Christmas period, the shopping period, and then in the normal seasonal periods, like it just hovers and then it consolidates. So basically, they make majority of their money during the Christmas period, which is very very common for these types of physical product companies because there's a lot of gifting going on, right? But you can see over time, for example, this the periods from Q1 to Q3, they will generally increase, but you can see when the guidance is bad, when the macroeconomic market is bad, for example, the revenue will start stagnating, right? And that's why, if you are not aware, like you can see the market cap of the Lululemon company also reduced over time, right? So when the economy goes into recession, for example, the purchases here, for example, if I buy one Lululemon legging, right, I feel great about myself, but it's really expensive, right? The next time I'm gonna buy it, it's not certain. It is not certain the customer will come back a second time because economy is doing bad, people are not spending money, and then like the company is not guaranteed this revenue over time, right? It may be guaranteed the first time you can acquire the customer, but then they just do not come back because it's just really expensive and it's not a need, right? Do you need another $150 $150 piece of pants? Like, not really, right? It does not change your life, right? So these type of companies, like I feel they're good if you are able to start your own business, right? If you can start your own Lululemon and then you can get it to scale, you make a couple $1,000,000, for example, it's a very fantastic business because if you own 100% of this thing, you can draw out the profits from this business. But then when you bring it into a public company setting, it's a completely different game already. In the public company setting, right, um, the shareholders expect you to increase revenue every single year, and you should not fail at this. If you fail at this, right, your stock price is basically going to plummet all the way down right here. Okay, and I've heard what the research analysts have been saying, where they are saying like stuff like, oh, like the on running shoes are eating up your market share. Your Deckers brand, for example, Deckers, they basically own Hoka's. Okay, they are like eating up your market share for Nike. But if you see Nike's revenue, for example, right, Nike is too big. Okay, Nike is very very big compared to these other people, and so I don't believe that they're actually eating the market share at all. So we'll just compare Nike. Okay, Nike, and then if you're not aware, On Running shoes, they're basically this hype running shoe brand, whatever. um and so let me check the revenue. Yeah, if you see the revenue is not even comparable. It's like almost laughable, right? It's like 700 million here and like 11 billion here. This is almost what, 11, 15 times bigger than this company. So I don't believe that it's like eating market share, because even though that the revenue here is like continuously increasing, right, it's like not proportional. Like this amount of revenue is not even like one speck of this amount here. And so even though the revenue here is decreasing, I don't believe that it's the competitors coming in and just eating up the market share, right? I feel that the problem with Nike, these companies, right, they, in order to increase profits and revenue over time, they start jacking up their prices, right? So I'm pretty sure everyone in the audience here today has been a Nike customer somewhat, right? And then I like the basketball element of Nike. Like I really like their basketball line. But when you start charging people $250, $300 for a bunch of shoes, for example, right, it gets a bit, it gets a bit iffy. Like it's, I'm not really getting the amount of value that I have versus the amount that I'm paying, right? And so if you see here, for example, 169, 175, 269 for these Kobe's here. Like I love Kobe Bryant, right? But like it feels like you're gonna kind of get ripped off here for the same shoe that, for example, 7 years ago, for example, it was like $180, right? And so these types of things come into the mind of the customer when they're buying something in the consumer cyclical category, right? All of these companies are consumer cyclical. You can see consumer cyclical, right? So these companies here, I would suggest if you want to invest, right, you only invest when it's like extremely cheap, right? Extremely cheap. Like you can see the market cap is like completely tearing down basically, right? And I do believe that it's gonna go down over time as well, because there is no fundamental story that will change this business until they really look at their prices. Yeah, just look at the prices, look at the value that they're giving, and like the quality of the product also has to increase over time if they're going to charge more and more for the same product over time basically. Yeah. Okay, so like these companies, I just want to let you guys know, don't be fooled by the headlines. Just because you think that Lululemon is a big name does not mean it may make you money, right? What I like to say is like don't be emotional about the stock, right? You personally may like Lululemon leggings a lot, But if you don't like the share price, if you don't like where the company is going in terms of the share price, like probably don't do that because you're gonna lose money. Okay. I'll show you another example, right? I think Deckers is another company right here. So Deckers owns Hoka brand. Let me just show you guys hack the Deckers. Okay, they own UGG, which is a winter shoe company. They own Hoka, which is a running shoe company. Which the analysts have been saying, oh, Hoka has been eating into the market share of Nike, etc., etc. And then Teva is, I believe, some random shoe brand that I'm not familiar with. But yeah, so you can see like majority of the revenue is coming from learn about more about our brands. They basically sell shoes in every single category. Yep. Right. So this brand right here, let's see how it's doing. So Decker's brand is about as big as Lululemon. I believe Lululemon is about $18 billion market cap. And then their revenue, you can see it's also very, very choppy. Right. It goes up, it goes down, it goes up, it goes down. I do believe that it goes up because of the winter season, where Deckers is very big in the winter boots category. But even on the smaller months, for example, you can see it is a very seasonal, very up and down business. Right? I personally don't like to invest in this kind of business because it's just not predictable, and your stock price is not going to move. Yeah. Another thing that you need to focus on for these types of companies, right, is you really need to understand their business. Right? So their business is basically they sell to everyone in the world. Everyone who has feet is going to buy a shoe, right? So they're going to sell to everybody basically, right? And then most of these brands, for example, they are going to sell to higher end customers, right? Because there's a higher profit margin. And so, for example, I'll just give you the unit economics. Okay, so for example, if they sell $180 shoe, they're probably spending anywhere from like $50 to maybe $80 on marketing alone, right? And then maybe their product cost of the shoe is maybe like $25. Okay, so I'll just put COGS, or cost of producing the shoe. Okay, the marketing spend could be, maybe I'll just reduce it to $30 to $80, and then the cost of shipping. So the cost of shipping is maybe like $10 or so, shipping the shoe. And then if there's a wholesaler, for example, they take a percentage or whatever it is. Maybe they pay $20 to the wholesaler or something like that, right? And so at the end of the day, if you minus off every single thing here, so 180 minus 30 is about what 150 minus 125 is about 125, 110, and then 90. So you probably get anywhere from maybe like $30 to like $90 left in like net profit. Sorry, I'll just call it profit here. Okay, keep in mind, right, all of these things here are still excluding your head count. So you have manpower, or you call it head count, all right? And then you also have like transaction fees. So you pay like Visa, you pay MasterCard or something, or whatever it is. If you have a physical retail store, you have rent. All right. And then apart from that, you also have like office space, warehouse cost. Okay. So you can see from just from this alone, right, there's so much things that are coming out. You from this amount, you still have this coming out. So maybe you pay $10 here. Transaction fees about 3%. So maybe I'll put like $9 or like $5 or so. And then rent, you probably put another maybe $5 for every shoe. And then office space, maybe like another $5, right? And so you can see everything is like eating into the margin. Okay, so you need to think about business like this. You need to think about these companies like this, where what are we selling it for, and like how much profit is at the end of the day, right? If you go all the way down 9.55%, $90 profit, right? It's maybe anywhere from like maybe $5 profit to like $30 profit, $40 profit off a shoe. Okay, so just keep in mind, like these businesses, you can see everything sucks up the cost, every single thing here. And then with the increase of inflation, right, this thing is going to go up, causes this to go up because the raw materials input will increase as well. Okay, so when you think about all of this stuff here, what are the variables that's going to make or break the business? Okay, number one, is the marketing going to get expensive? Yes, because if you think about it, right, Facebook advertising is going to go up, Google advertising is going to go up. So how do people attract attention and shoes and sales and stuff like that, right? The COGS is going to go up because inflation, raw cost is going to go up. Shipping is going to go up because, yeah, shipping always goes up, right? If you think about the wholesaler, right? So for example, someone like Foot Locker is carrying these shoes, right? They may have to increase their own profits, right? So they also want a bigger percentage and stuff like that. All right. The manpower headcount, this is quite, I would say it always goes up, right? Or people are always asking for more money. Transaction fees, I would say, probably put it stable. The rent is definitely going to go up. Yep. And then office space, warehouse is going to go up. So if you see everything here, everything is going to go up. So the profits at the end of the day are going to reduce over time. Yep. And with Trump in office, I don't think it's going to get any better than this, right? You have to include one more thing with Trump. So this guy here has tariffed the entire country. So Americans are basically paying out of their ass for this product right here. So if you add in another tariff of like, I'm going to cut in maybe what, 15 to 20%, 25% of your profit here, you can see how the earnings are not going to be good over time, right? And so these companies right here, they are all prone to these volatile situations in the market. Okay. Another thing that you can look at is that where are the sales coming from? Okay, what do I mean by this? Okay, if I go to, sorry, let me just go back to Nike. Okay, if I go to Nike, right? I believe it's over here. Yes. So Nike, for example, like you can see, majority of the revenue is coming from North America. It's coming from the US. Okay. So if you believe that the tariffs are going to affect this amount, it definitely will be. And majority of the revenue is coming from the tariffed region, your profits are going to decrease significantly. Okay. So like I would advise you to stay away from these companies for the time being. I won't say they're bad companies. It's just that this environment, they're just not doing really well in this environment. Okay. So if you're going to put your hard-earned money to somewhere, you probably should pick something else, just letting you know. All right. Lululemon, okay, for example, we'll see the same situation. Geographically, you can see here China is becoming a very important part, but US is still majority of the revenue. So that's why the stock is also getting destroyed, basically. People are going to say it's cheap or whatever it is, but if you understand the business, it's like, bro, I don't think so, man. Like US is making up majority of the revenue, and the tariff is going to slap your ass. So probably don't do this. Yeah, don't do this to yourself. All right. How about Deckers right here? So Deckers over here. Okay, there's no information. Never mind. What about On Running shoes? There we go. So On Running shoes, same situation, right? Very US centric, very USA focused. Majority of their revenue comes here. Um, sorry, yeah, the US. Oh my goodness. Okay, so US alone is 36%. The Americas is 39%. Okay, and then Europe is the rest and stuff like that. Yeah, but you can see even on an on holding shoe, right, where you would think that Europe would, occupy a bigger segment of that sales and the revenue, right? Europe is only over 15%, and this includes the Middle East, Dubai, etc., etc. Okay, so just to summarize this video, I hope you guys see the situation, see the problem. But whenever you go and invest into a company, you want to make sure your hard-earned money is being protected. Like you want to be making money, don't be losing money, man. If you're losing money, you might as well just go and start a business and do some risky stuff, or you just go and buy crypto. Like at this point, just go and buy crypto, right? But just make sure that when you look at these companies, look at it objectively. Like just go and look at how they make money. They make money by selling shoes. Okay, they make it for $25, they sell it for $180. So that's anywhere from a maybe 5 to 10x markup, right? But where are the costs going? The costs are going here. They're going to Facebook and Google, right? So these people are going to make money regardless. So maybe buy these tech names. Okay, the factory, for example, is going to go up because inflation is going to go up. Shipping is going to always go up, basically because somehow it's always more expensive to ship stuff nowadays. And then the wholesalers, the Foot Lockers, they want to make more money as well, so they're going to extract more. People are going to ask for more, more salary over time. Transaction fee here, rent. I don't know whether you are aware, but everywhere the rent is going up, right? So you can feel it already, and that's why this is basically the nail in the coffin. Like this guy is basically going to kill these companies right here, or a lot of the smaller players are going to get killed. All right, and so this is going to affect the earnings, going to affect the bottom line and stuff like that. Okay. I just wanted to show you this, just one more slide here. So if you go to the graphs tab over here, you can basically do these financial metrics or like financial analysis. So maybe I don't know whether Lululemon has. Oh yeah, so Lululemon has a 10-year history, right? So you can see according to the history, right? Consistently they have been executing over time. They have been consistently increasing their revenue and their profit. So the profit is basically this purple graph over here, but you can see the profit is actually not like consistently increasing, right? this is a well-run company, but this environment where they are coming into is going to be extremely difficult for them, and I don't know how they're going to consistently increase their revenue during this period. This is for Lululemon, right? If I search Nike, let's see how Nike is performing. Um, is it annual, quarterly? Uh, why isn't it giving me a 10-year chart? Okay, yeah. So you can see here, like Nike, even though they've been growing from 9 billion to the peak was maybe 13 billion. You can clearly see like it is the growth has slowed over time and it has almost been decreasing over time. So we have come to a point where there are just enough people who have bought Nike and they just don't want to buy any more Nike, right? You could also say the brand is becoming irrelevant and stuff like that. But at this scale, for example, you basically run out of people who want to buy your brand, right? And that's okay. That is totally fine. Like companies cannot grow forever, and that's why you need to understand this thing of like what the other companies like a Google or Microsoft, for example, the reason why they can continuously grow, like basically it looks like they can grow infinitely, right? It's because they have this recurring revenue thing going on. They're able to predict revenue over time. Okay, versus these companies right here, yeah, it's very hard to predict revenue. Okay, if I compare this side by side, right, Google and Nike, you can see Nike goes up and then Nike goes down. If you see Google, right, over the 10-year period, they have never missed. They have literally never missed. Let me 5 year. Can you see this? They have been consistently increasing, and the reason why the growth is like oh slow, 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 and it goes boom, and then like they don't really have a down year. They don't really have a down year at all. These up years, for example, is when people are start spend money for advertising on their business for like Christmas time period, Black Friday time period. But apart from that, right, you can see the net income is also it slowly goes up over time. Yeah, just now you saw Nike, right? Just up and down, up and down. It's super unpredictable, and yeah, you don't really want to be in that kind of stock. Yep. Okay, so hopefully you learned something. Hopefully I've shared some of my knowledge with you that can help you over time. But whenever you spot companies like this, right, try to stay away. Or if you don't believe me, right, just go and do the breakdown of like where their money is going. Because once you figure this out, right, if there's too much volatility going on, if there's too many variables going on, right, you want to stay away from those types of companies. Okay, yep. Hopefully this makes sense to you guys, and let me know what other videos you want me to create as well. All right, thank you.